Hello, and welcome to our weekly wrap-up of Eurotech. I'm your host, Simon. This is the news update for the week of October the 19th to the 25th, 2025. In this episode, we'll cover some major developments in Europe's tech scene. We'll discuss a major merger in the space industry, a green electronics marketplace securing new funding, an AI startup facing layoffs, a Norwegian startup revolutionizing software development, and one of the largest seed funding rounds ever for a European AI company. Let's dive in. Our first story is about three of Europe's aerospace giants, Airbus, Thales, and Leonardo, teaming up to create a new space company. These companies have signed an agreement to merge their satellite and space businesses into one joint venture. The goal is to combine their strengths and make Europe more competitive in space. Right now, companies like SpaceX and US giants like Boeing and Lockheed Martin dominate much of the space sector. Europe doesn't want to fall behind, so it's forming its own space powerhouse to rival those players. So what will this new venture look like? Airbus will own 35% of the new company, and Thales and Leonardo will each own 32.5%. The plan is for the company to officially launch around 2027, pending approvals. It will be headquartered in France and bring together thousands of employees and numerous projects under one roof. In fact, the combined company is expected to have about 25,000 employees across Europe and roughly 6.5 billion euros in revenue. By pooling resources, they aim to innovate faster and achieve economies of scale. Each partner is contributing key assets. Airbus is folding in its space systems division. Leonardo is contributing its space unit, including its stakes in satellite ventures like Telespazio and Thales Alenia Space. And Thales is adding its own satellite activities and holdings. In simple terms, they're putting all their satellite manufacturing, space tech, and related services into one basket. Notably, this deal does not include rockets or launchers, which will remain separate. Why are they doing this? The CEOs of the three firms said it's about strengthening Europe's strategic autonomy in space. Europe wants to ensure it can build and operate the satellite and space infrastructure it needs, without relying too much on outside players. By uniting, these companies believe they can accelerate innovation and better service customers in areas like telecommunications, navigation, Earth observation, and even future exploration. Importantly, officials like the European Space Agency's director have welcomed the move. They say it will change the landscape of the European space industry and make the sector stronger globally. Of course, it's a big consolidation, so European regulators will watch how it affects competition within Europe. But overall, this merger is seen as a bold step to give Europe its own space tech champion. In summary, Airbus, Thales, and Leonardo joining forces creates a European space giant that can stand up to global competitors. It's like Europe is assembling its own SpaceX rival, with a uniquely European twist focusing on satellites and services and ensuring we have the know-how here at home. Now, let's move from space to something a bit more down-to-earth, our gadgets. Refurbed, an Austrian startup, made news this week by raising 50 million euros in fresh funding. Refurbed runs an online marketplace for refurbished electronics. In simple terms, that means they take used devices like smartphones, laptops, and even kitchen appliances and professionally repair and restore them so they work like new. Then they sell these gadgets at a discount, usually with at least a 12-month warranty, to assure quality. It's a way for people to get good as new devices for less money. And it's great for the environment because it extends the life of electronics and reduces e-waste. The company, founded in 2017, has grown quite a bit. It operates in 12 European countries and has handled over 9 million devices for about 4 million customers so far. Those are big numbers, showing that many consumers are embracing the idea of buying refurbished gadgets. Refurbed also tracks the positive environmental impact, like CO2 saved and less electronic waste, highlighting the sustainability aspect of its business. So, what happened this week? Refurbed secured a €50 million investment round, about $53 million, to fuel its growth. The funding was led by a group of investors, including names like Alex Zubilaga and Aurelia Asset Management, who believed in the company's mission and potential. With this new capital, Refurbed plans to expand into the UK market and broaden its product categories. That means you might see more types of products available on their site and their service becoming available to more customers in Britain soon. They're also aiming to enhance their platform's technology, including using AI, to improve customer experience and make operations more efficient. For example, better AI could help match supply and demand, ensure quality control, or personalize the shopping experience. One notable thing about Refurbed is that it's not just growing, it's growing responsibly. The company became profitable in March 2025 and saw about 40% year-on-year sales growth. In the startup world, many companies prioritize growth at all costs and worry about profits later. But Refurbed has shown it can do both, grow and make money. As the co-founder Peter Windishofer put it, "We prove that doing good and doing well aren't opposites. Now it's time to make refurbishment mainstream." This track record of combining profit with purpose likely helped convince investors to put in money. In terms of global strength, Refurbed is one of Europe's leading players in the refurbished electronics space. Globally, there are other companies refurbishing gadgets, for example in the US and Asia, and big marketplaces like Amazon also sell refurbished items. But Refurb in Europe, with its focus on quality, every item goes through a multi-step renewal process and warranty-backed sales. This new funding will help it compete more strongly on the world stage of re-commerce, reselling electronics. It shows that European startups in the circular economy can attract significant investment. For consumers, it might mean more choices of refurbished tech and greater awareness that buying refurbished is a smart, green option. Overall, Refurb's success this week tells us that sustainable tech business models are thriving in Europe, with solid growth and investor confidence behind them. Next up, we have a more sobering story from the AI startup world. Robin AI, a London-based startup, announced layoffs this week due to disappointing growth and a funding setback. Robin AI is a company that uses artificial intelligence to help lawyers review contracts. Essentially, they built a system where AI algorithms and human legal experts work together to speed up contract review and analysis. The idea is to save companies time and money on legal paperwork by automating parts of the process, like checking clauses, spotting risks, etc., while still having human lawyers in the loop for quality control. The startup has gained a lot of attention and raised significant money in the past. By early 2025, Robin AI had around 200 employees across its offices in the UK and New York. It had also raised about $70 million from investors, including SoftBank, Temasek Fund, and notable venture firms. These are big-name backers, and it showed that Robin AI was seen as a promising player in legal tech, the intersection of law and AI. In 2024, the company doubled its revenue to roughly $10 million, which sounds great, but apparently 2025 didn't continue that explosive growth trajectory. So what went wrong? According to reports, Robin AI tried to raise another $50 million in funding this year, but failed to close the round. Investors have become more cautious, especially in AI, wanting to see strong revenue growth. Robin's growth fell short of expectations in 2025, which made it hard to get new investment. Without that infusion of cash, the company decided it had to cut costs. They are laying off roughly a third of their staff. Earlier in the year, they were at 200 people. They already quietly shrank to about 150. And now about 50 more roles are being eliminated, bringing the team to around 100 or just under. This is obviously tough news for the employees and the company. Robin AI's CEO hasn't given a detailed public comment, but insiders and analysts have some insights. The core issue is lower than hoped-for revenue growth. The company's sales didn't grow fast enough to justify more big investments. They had raised a lot, around $50 million in 2023 to 24, but that didn't translate into the massive 2025 growth that venture capitalists like to see. The broader context is that competition in AI-powered contract review is extremely intense. There are multiple fronts of competition. Traditional contract software companies adding AI features, other AI startups, some even newer ones like Harvey or Legal, that have raised big sums, and even in-house legal teams experimenting with general AI tools like ChatGPT. Big software companies, for example Workday, are also launching AI tools for legal departments. In short, everyone is trying to apply AI to legal documents right now, and Robin AI is one player in a crowded field. This makes it hard to grab market share. Robin AI's situation also highlights the pressure that comes with taking money from large investors. When huge funds like SoftBanks invest, they often expect very rapid growth in return. If a startup doesn't keep hitting ambitious targets, it can fall out of favor with investors. It appears Robin AI hit that hurdle. They grew, but not enough for the next big check. So how does Robin AI plan to move forward? The company will likely refocus on its core product and existing customers, trying to improve its financials. They have appointed a new CTO from within after some turnover in top positions. There's speculation that Robin AI might consider being acquired by a larger platform or partner, which is something that happens when startups can't sustain on their own. For example, a bigger legal software company might buy them for their technology or customer base. Nothing like that has been announced yet, but it's a possibility raised by industry observers. In terms of global standing, Robin AI's story is a bit of a cautionary tale. It was, and still is, one of Europe's notable AI startups in the legal field, even attracting global investors. But being AI plus Europe isn't a guaranteed success in the global market. The global competition, including startups in the US and Asia, and the fast-moving nature of AI means European startups need to execute extremely well to keep up. Robin AI's struggle shows that Europe can produce cutting-edge AI ideas, but scaling them into sustainable businesses is challenging. It's not all doom and gloom. The company is still operating and could stabilize. But this week's layoffs signal a reality check. For European tech, it's a reminder that along with big funding rounds and government support for AI, individual companies must find real market demand and efficient growth paths to succeed internationally. On a more upbeat note, let's talk about Riff, a Norwegian startup that just raised money to help more people build software without coding. Riff, based in Oslo, secured a €14 million Series A funding round led by the VC firm Northzone. Series A means it's one of the first significant investment rounds for a startup that has shown some promise and growth. This brings Riff's total funding to about €18.4 million so far. So what does Riff do? It has a platform for something the founders call vibe coding. In plain English, Riff's platform lets non-technical people build data-heavy AI-driven applications without writing code. Think of tools like Wix or WordPress, but for apps and internal tools, not just websites, and with AI built in. Many companies have tons of data and potential AI use cases, but they lack enough software developers or the know-how to turn those ideas into real software. Riff aims to solve that by providing an easy-to-use interface, templates, drag-and-drop components, etc., plus robust behind-the-scenes infrastructure. The result is that business analysts, operations managers, or other doers in a company can create functional apps and automations themselves. Why is it called vibe coding? The idea is that you can build software that matches the vibe or desired outcome you have without coding. Under the hood, it's leveraging AI to fill in the gaps. One interesting stat: an MIT study found that 95% of AI initiatives never make it into real production use. They stay as experiments. Riff's team cites this to highlight the problem. Lots of AI projects sound good, but fail to implement. Riff wants to be the solution by making it easy and reliable to go from idea to a working, deployed app. Now, Riff has already gotten some traction. Over 150,000 users have tried Riff's platform, and companies like Twilio and Cognite are using it to streamline their internal operations. Twilio is a big US communications tech company, and Cognite is a Norwegian industrial software firm. So that's a mix of global and local endorsement. These users have built tools in areas from manufacturing to finance to healthcare on Riff. This shows that even before this new funding, Riff was proving its value. With the new €14 million investment, Riff plans to expand its features and reach. They are introducing new capabilities like AI agents that can build custom automations. Think of AI helpers that can handle tasks such as syncing data between systems, sending alerts, or processing multimedia. They're also adding integrations with popular workplace tools, for example HubSpot, Google, Drive Sheets, Stripe, Notion, etc. So that app built on Riff can easily connect to the software companies already use. Another planned feature is background agents that let users make bigger changes or get updates on the fly, even from a phone. All these are aimed at making the platform more powerful for enterprise needs. Of course, a chunk of the money will also likely go to growing the team and marketing to get more companies on board. From a global perspective, Riff is part of a broader trend towards low-code or no-code platforms, tools that democratize software development. What's notable is that Riff is incorporating AI heavily, which is very timely. Investors like North Zone are excited because they see vibe coding as a transformational shift in software development, where anyone can create, launch, and maintain applications without coding. And they believe Riff's focus on making apps truly production-ready, not just toy projects, is what sets it apart. In other words, Riff isn't just another hobbyist app builder. It's aiming for serious business use from day one. Europe's tech ecosystem seems to support such tech ideas. North Zone, which is a well-known European VC that invested in Spotify and others, backing Riff shows confidence in this approach. Riff will, of course, face competition from other no-code platforms globally. There are US companies like Retool, Bubble, etc. in somewhat related spaces. But with its AI twist and already sizable user base, Riff could become a leader in this next wave of enterprise software tools. It's a sign that European startups are innovating in the developer tools and AI integration space, potentially shaping how software is built in the future. For our listeners not deep in tech, basically, Riff's success could mean that in a few years, building an app for your business might be as straightforward as making a PowerPoint deck, and that innovation is being driven by a team in Europe. Finally, let's talk about a headline-grabbing funding story. General Intuition, an AI startup with roots in Switzerland and the US, has raised about $134 million in a seed round. Yes, you heard that right, $134 million at the seed stage. In euros, that's roughly 114 million euros. This is huge for a seed round, making it one of 2025's largest early-stage AI investments. To put it into perspective, most seed rounds are maybe a few million. Even Series A rounds, the next stage, for AI startups in Europe often range from 3 to 12 million euros. So this is an outlier. It signals a ton of investor excitement and expectation for General Intuition. The round was co-led by Khosla Ventures and General Catalyst, big names in venture capital firms from Silicon Valley. Also participating is Rain, an investment group. Having these investors on board is significant. It means top global investors are now betting on this company. Now, General Intuition is based in New York and Geneva. It was founded just of this year, 2025, as a spin-off from a platform called Medal. Now, what does General Intuition do to justify this kind of money? The startup is working on AI agents with advanced spatial reasoning and learning, using video game environments as training grounds. That's a mouthful. Let's break it down. Medal, the company it spun out from, is a popular platform where gamers upload short video clips of their gameplay. In fact, Medal gets nearly 1 billion gaming videos posted each year from 10 million monthly users. These clips show players navigating virtual worlds, overcoming challenges, or failing spectacularly. Basically, a massive, varied dataset of how entities, the players, move and act in many scenarios. General Intuition's insight is use those gameplay videos to train AI agents to understand and operate in complex environments. In video games, you often have a character moving through a 3D world, avoiding obstacles, completing tasks. If an AI watches thousands of hours of that, it can start learning spatial awareness, understanding surroundings, and decision-making in a dynamic environment. The company's CEO, Pim DeWhite, described it like this: when you play a game, you transfer your perception into a new environment through the character's eyes. Each game clip is like a mini-story of actions and consequences in a particular world. Those are exactly the kind of situations you want AI to learn from, especially for tasks that involve moving in physical space. The AI agent's General Intuition is developing only to see what a human player would see on the screen and learn to act using the same controls a player would use. Importantly, this approach doesn't rely on any special labels or annotations. It's learning organically from what players upload, the successes, the failures, the edge cases. The hope is that what the AI learns in these virtual worlds can be transferred to real-world applications. For instance, think of a robot or a drone. Many drones and robots are actually controlled by humans with devices similar to game controllers, and they operate in 3D space. If an AI agent has learned strategy and movement from games, it could help a drone navigate a collapsed building in search and rescue missions, or help a robotic arm figure out how to move in an unstructured environment, all by applying the common sense it learned from games. General Intuition says they'll use this funding to scale up their research team and continue developing these AI agents. They have several research goals like building world models, AI simulations of environments, improving video understanding beyond gaming, and generally pushing toward more embodied AI, meaning AI that understands the physical world, not just text or images. They've even mentioned plans to launch AI-powered non-player characters, NPCs, and simulation tools by the first half of 2026. NPCs are those characters in video games that are not controlled by a human. Imagine those being powered by this advanced AI. They could be much smarter and more adaptable than the scripted bots we have today, reacting to player actions in more human-like ways. and those improvements could feed back into making the AI better for real-world tasks too. In terms of strength and significance, this deal is a big deal for Europe's tech scene, even though it's a cross-Atlantic startup. Firstly, it's proof that if a European-founded team, Pimdy White and others have European roots, has a bold vision, they can attract massive capital, but often by engaging US investors and having a US presence, as General Intuition did. It also underscores a trend. Europe may not throw up dozens of huge AI funding rounds, but when it does, they tend to be around truly novel, deep tech ideas. Another example this year was the Paris-based Mistral AI, with its big raise. General Intuition's €114 million seed far exceeds typical European AI funding sizes. In fact, it's more like what we'd expect in Silicon Valley. This injection of funds could quickly elevate General Intuition into the global big leagues of AI research labs, alongside the open AIs and deep minds of the world, if they execute well. For the European tech ecosystem, having part of this company in Geneva is exciting. It means some of this cutting-edge research will happen on European soil, potentially creating jobs and expertise here. It also might inspire other European researchers and entrepreneurs that huge moonshot projects can get support. The flip side is it shows Europe's reliance on global capital. The money largely came from American VCs, not local European funds. But regardless, the takeaway is that Europe is contributing big ideas to the AI revolution. Using gaming to teach AI is a creative approach, and global investors are paying attention. In conclusion, the state of European tech this week is one of high hopes and practical reality. Big dreams are being funded and big companies are coming together, showing confidence and momentum. At the same time, the road to global tech leadership has bumps, and success isn't guaranteed for every player. But each of these stories, whether it's a merger, a funding round, or even a painful restructuring, it is a sign that European tech is dynamic and pushing forward. It's an ecosystem learning to play to its strengths, like unity, innovation, and sustainability, while adapting to challenges, like competition and scaling. That's all for this week's European Tech Roundup. Thanks for listening, and stay tuned for more updates next time.